All right, good afternoon, everybody. Welcome to Wook Capital Management's 11th Wook in Review presentation and discussion. For those of you tuning in for the first time, just so that you know, we have a corresponding visual presentation that comes along with the broadcast. So if you're tuning in through Spaces only, of course, you're going to be audio only. If you'd like to follow along with the presentation, materials. Those are available in the Wook Capital Discord. Wook.gg in your URL will bring you there, and you can follow along with visuals live. Otherwise, the visuals and the recording will be available on YouTube afterwards. I do just need to read a disclaimer here real quick before we get underway. Um, so just want folks to be made aware that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Okay, with that mouthful out of the way, um, we're going to kind of go through some economic data. There was a lot of economic data out this week, so we'll be talking a little bit about that. The focus of this week's newsletter was the American consumer. We obviously got some jobs related data this morning that we didn't include in the newsletter, but that I'll be going over a little bit of. And I would say that the prepared materials should take us about 25, 30 minutes to get through. So once we get through that, we'll go ahead and open the floor up for a conversation with anyone welcome to chime in. Until then, though, I'm mostly going to just go through my prepared materials. So by around 4:30 or so Eastern, we'll get to the more open mic portion of the discussion. So, okay, what's going on? Recapping major events of the week and discussing the state of the American consumer. So, um, first, just reminder for folks, we do have our second book club coming up, which we'll be hosting on Tuesday at 7 p.m. Eastern. So, we had hosted one of these a month or so ago. This is our second one. Our expectation is to host these on a monthly basis going forward. This month we'll be covering Howard Marks' The Most Important Thing, Uncommon Sense for the Thoughtful Investor. So we will be doing that on Spaces at 7 on Tuesday the 6th, and the recording will be made available on our YouTube afterwards. So we hope to see some of you there. I'm gonna recap some of the highlights from the week. I would be remiss not to discuss just a little bit about what happened with the chairman, Jerome Powell's Brookings presentation. So we did host a Spaces earlier this week where we had live streamed the audio and then had a little bit of a conversation afterwards. That recording's available on the Wook Twitter handle. I included the link in the newsletter. Um, there was a good Reuters write-up that I have pulled up on screen, kind of talking about some of the puts and takes and considerations from Powell's uh, Brookings conversation. And I think, again, if you're following along on screen, you can kind of see the story. I think if you just Googled Reuters Powell financial conditions, you could probably pull that up through Google. Reuters, of course, stories are free if you have a free account. Otherwise, archive.ph does wonders if it's not. But we went into the call with financial conditions having loosened somewhat ahead of his presentation, and it seemed like the market was expecting him to be a little bit more hawkish than he came off. He ended up coming off as fairly dovish with some of his language, which, as the story kind of notes, and I kind of agree with, there really wasn't a change in his messaging. So, for example, in the story, it notes that economists at Piper Sandler argue that Powell did not say anything new, and note that markets usually rally after his public communications. If the Fed decides it does want to push back against the market's interpretation of his latest comments, it might have to wait. And the reason for that is that as of tomorrow, the Fed is in a blackout period. So there were a couple Fed speakers that followed him this week. There was Barkin today in a speech to the Virginia Economic Summit and Forum on International Trade, who noted, similar to what Powell noted, that labor supply looks like it will remain constrained. The Fed's efforts to bring demand back in balance won't be easy when Americans still have about 1.3 trillion more in savings than they did pre-pandemic and fiscal stimulus continues. So, that messaging doesn't seem to align with the exuberant reaction that was seen after the call. So, I have up here a screen, a snippet of Goldman Sachs Financial Conditions Index, which after his presentation, the Financial Conditions Index eased by 21 basis points to its lowest since September 12th. So, uh, and that was mostly led by the rally in equities. So on that measure, just Goldman's measure, financial conditions are actually easier than they were ahead of the prior two 75 basis point hikes. So it's obviously not a perfect measure, but thinking about how tight or loose financial conditions are, even though there have been those two 75 basis point hikes in September, November, atop the two that preceded them, the financial conditions are being measured as looser than they've been in months. So this write-up kind of talks about, well, did Powell want to loosen conditions such that there's more of a buffer? There's some prognostication about, the end of the year is illiquid, and perhaps giving equities more of a buffer heading into December, such that if there's any drawdowns, it may be less, right? If you're starting from a higher high, that minus 10% hurts less than if you were already at the bottom, so to speak. So, who knows what the logic was? Clearly, the market interpreted him as dovish, and we won't hear until December 14th when we get the next Fed meeting. We'll get a new summary of economic projections from the Fed. We haven't had an update to that since September, so we'll see what the Fed governors see, the FOMC committee members see as an expectation for unemployment through the end of next year, for the Fed funds rate with their dot plot revisions. So we've got that to come, but obviously the Powell comments were construed as dovish and led to that big rally and easing in financial conditions. So other highlights, there's been reporting of protests across China as locals are just over it, I guess you could say, with regard to the ongoing COVID zero policy that has been in place since this all began, going on now 3 years. So really, we talked in a couple Wook in reviews back about how President Xi had consolidated power and kind of got all of his yes men, so to speak, lined up in the ranks behind him. And kind of the reporting in net seems to believe there's just not a lot of flexibility that he has. He has been kind of the proponent of COVID zero. A political scientist focused on China at the University of Michigan noted in the Wall Street Journal, quote, Xi's leadership is in a bind. If they compromise and relax zero COVID, they fear it will encourage mass protests. If they repress more, it will create wider and deeper grievances. So there were some changes since this reporting earlier in the week about vaccinations for older people. I think they're trying to walk a fine line to not see the protests spread, as well as ensure that that messaging doesn't necessarily change. That they will likely not come out and say that the policy has ended, right? But they may give locales some more flexibility to not be as strict with the lockdowns. We'll see, right? China is obviously a little bit of a black box. But the implications are if COVID zero is eased and China begins to reopen, that would be what are the implications there? There's incremental demand for raw materials, for fuel. You're going to see some inflationary effects if that reopening were to go ahead full bore, but it's still uncertain. There's not been any official policy change, but seeing kind of this uptick in what appears to be kind of the most widespread protest in many years in China is definitely something to monitor. Okay, so then that leads us into more of the nuts and bolts of the prepared conversation that I have. So going back to the Powell speech on Wednesday, we had him talking about the problem that is a lack of labor supply, and that the Federal Reserve doesn't have tools to address labor supply. They really can only address the demand side of the equation. So there's some different metrics out there. I'm going to kind of talk through some of those, and then pull up the Wall Street Journal does a nice job with their economics newsletter, and they put one out today after the jobs report to kind of talk about some of the different puts and takes, and then I'll welcome folks to share what they're thinking and seeing, and after I get done with this. So, what do I have in the newsletter? I have a visual of the Indeed.com job postings. So if you're unfamiliar with them, Indeed.com is kind of one of those leading job boards. And since before COVID began, since February 20, they've been measuring as a baseline the kind of change in job postings on Indeed. And we talked in our market open mic about the JOLTS report, that came out earlier this week, and how that shows that there's 10.3 million open jobs, and then there's a lot of discussion around how reliable is that report. Well, Indeed.com, presumably, new job postings that have been posted within the last week. That's a pretty fresh metric, right? And as the visual shows, that's still around 50% above where they were before COVID hit. So there's still clearly, from that and some other measures, a big mismatch where there's a lot more listings than there are folks looking for work, right? There's a mismatch of the quantity of labor that is being demanded and the quantity of labor that is being supplied. And the Fed chair shared a little bit of discussion on that at Brookings, with the view that it's a big chunk of that is early retirees. I think it was 1.5 million of the 3.5 million, or two, maybe mixing the two up. Either way, it's roughly directionally in the same space, that we have a large swathe of the population that's aged and opted to retire and does not appear to be coming back to the labor force. You also have the cumulative effect of immigration policy, fewer people immigrating to the country, and that's caused some lack of supply on the labor side. And he obviously was delicate about his phrasing, because the Fed is not trying to influence fiscal and congressional policy, but that if there were policies that allowed more labor supply to come into the country, that would certainly make their job easier. And there were a few kind of things I included in the newsletter. So, for example, I saw this Society of Human Resource Management professionals, SHRM, had a couple months back done some surveying of workers and how they feel about the formerly convicted, or folks with prior convictions working alongside them. So they surveyed over 1,000 workers from Indeed and found that 92% of workers were comfortable working alongside a coworker who has a nonviolent criminal record. 91% said that providing fair job opportunities to individuals with a criminal record is essential to society. 73% would prefer to work for a company with fair chance hiring practices. So it seems like the employee sentiment is pretty positive when it comes to nonviolent former convicts working alongside them. And even 66% agreed they'd feel comfortable working with someone with a single isolated incident on their record, even if it was violent. So I think that's interesting to see that there's an apparent openness from the employee side. Now, the employer side is a little bit contrary to that. So that's part of the puzzle, at least from a convict perspective. The employer side of the survey showed that only 33% currently offer employment to job seekers with a criminal record. So there's a little bit of a mismatch there, right? And then that beggars questions about the racial implications, right? Because it notes that 38% of the incarcerated population is Black people. Meanwhile, they're only 12% of US residents. So the disproportionate impact on folks of color is kind of drawn clearly with that. So I thought that was interesting. And then the other one is kind of talking about, okay, so we've got the fact of who is eligible, right? If you're convicted, you're already X'd out. Well, the other one is you have the necessary credentials. So a lot of the time, if there's a college degree requirement, right? So the Wall Street Journal had a story out last week talking about employers rethink the need for college degrees in a tight labor market, and it cited a few blue chip companies, Google, Delta, IBM, reducing requirements for some positions. There's a few good visuals in this story. Again, you can follow along in the Wook server. I'm presenting visuals. I'm doing my best to make sure I verbalize what I'm showing on screen as well for those listening to audio only. Um, there's a visual showing what percent of job postings require at least a four-year college degree, and it has trended down over the last few years, albeit in the last 12 months, it trended back up. It's still lower than it was pre-COVID, but we're still talking about over 40% of job postings requiring at least a four-year degree. And the logical question is, do all of those job postings truly require a four-year college degree? And certainly the answer is no. What is the right mix, I think, is a fair discussion to have, right? So gets back to this like broader societal discussion around we live in a very credential oriented society where people go out and get these degrees. They invest a lot of time, the opportunity cost of going to college, the explicit cost from a tuition, room and board perspective of attending college. um, those are very real costs, right? And you have a lot of workers who may incur debt and not ever complete the degree, and now they're in kind of the worst of both worlds. So the story has some good discussion around different employers no longer requiring four-year degrees for some of their roles. Um, Walmart, for example, a lot of these, you hear the stories of the person who started as a fry cook at McDonald's and worked their way up to become a manager. Walmart notes that 75% of its U.S. salaried store management started, in hourly jobs as a greeter, as a cashier, as a stocker, et cetera. So, those are a couple good examples, right, of how not having the degree requirement is working for them. And there's a couple other data points that I think are kind of worth sharing, right? Because you have a big chunk of the labor force that simply doesn't have those credentials. So if you're talking about 70 odd million Americans in the labor force who don't have a bachelor's degree or higher, that could be cause for some of this disconnect between job postings that require it and there just not being a supply of labor that satisfies that. So I wanted to talk about a couple of those things about kind of the labor supply side of things. All right, let me keep going before we wrap the prepared remarks and kind of welcome up the conversation. So expect sales this holiday season. There was some reporting in the journal this week about retailers having more promotional pricing, even if they don't necessarily have a need to get rid of overstocked inventory. So the story was out last week, and it basically, in a nutshell, is saying many big retailers are discounting heavily and earlier this season to clear excess stock. Okay, we know some are overstocked, right? You've heard about this all year about some of your big boxes like Target and Walmart, and some of them being more successful than others. And in getting their inventory levels where they need to be. But there's some commentary from different folks in business, and kind of the nuts and bolts of the commentary is that consumers are looking for deals. And I mentioned a comment from Amazon CEO Andy Jassy that was had earlier in the week at the DealBook conference, where he basically said, um, if I can get my notes right, that quote, consumers are spending, but they're being careful about trying to stretch their dollar. People care a lot about getting a bargain right now. So Amazon, obviously one of the largest retailers on the planet and in the country, has a pretty good sense for what consumers are feeling. And this journal article kind of talks about how, because of that, that bargain hunting mentality driven by some of those, poor consumer sentiment, inflation biting away at their disposable income, leading to this mentality of I'm not stopping you unless you have a deal. And the retailer may not be overstocked, but it's like I'm going to offer 10, 15, whatever percent anyway, because I need to meet the customer where they are. So um, one of the quotes was, any discount that doesn't have a two in front of it probably doesn't get anybody's attention at the moment. Well, yeah, if I see 15% off, personally, I don't really care. That's not really a discount. We're just been kind of trained to feel that way, and especially based on, for some consumers, based on them just having a limited discretionary budget. So then the other story on the inventory side was from the journal's logistics report, talking about how, whereas on the prior holiday season, many retailers were scrambling and were very short stocked, and we had the entire, the massive spike in container shipping costs that is, of course, normalized meaningfully and rapidly this year. But last year, folks couldn't get their shelves stocked, or they were paying through the nose, whether it's through air freight or other, to get their shelves stocked. So now some merchants, and the journal cites Dick's Sporting Goods, Lowe's, that uh, they're getting their inventory levels. And the CEO of Dick's noted in the earnings call 2 weeks back, quote, "We're really thrilled that we have in stock for Q4 inventory for the first time in a few years that's going to be robust." So you don't want inventories to be too high, right? But it's interesting to hear that sentiment from some of these bigger box merchants, that they're happy that they have some overstock and that they have their shelves fully stocked. We'll see if that tune changes come 4Q results in the spring, if maybe they regret overstocking so much and needing to move inventory at markdowns and cutting their margins. But it's certainly interesting. There's some data from CBRE, which does real estate management, saying that in its survey of 13 malls and outdoor shopping centers that it manages across the US, it found no problems with shortages of goods during Black Friday this year. So it's definitely a change from last year and the year before, where you're struggling to find in stock, and maybe you were willing to pay, MSRP, and now there's a lot of stuff in stock. Merchants seem to be all right with that, some of them, and even if they don't have overstock, they're feeling a need to meet the consumer where they are with offering discounting. And then a couple Census Bureau data points kind of talking about inventory to sales ratios, which, depending on which slice you're looking at, for example, the overall retail sector's ratio of inventories to sales is still tighter than it was before COVID by a little bit. It's at 1.25 versus 1.47 in September of 19. So broadly, it doesn't seem like the glut of inventory is a problem for the overall sector. But then if you slice a little more narrowly, you can see that for general merchandise stores, which goes back to what I just said about like the Targets and Walmarts of the world having been overstocked. And you can see that the inventory to sales ratios are elevated and have been elevated really for most of this year, just now starting to inflect downward. So that's a little bit of what's going on. That's a part of the story. So then getting to the state of the consumer. All right, we talked about the business. Let's talk a bit about consumer. So I included a few visuals, and let me zoom in on my screen. Again, if you receive the newsletter, I'm referring to the visuals in the newsletter. If you don't, you can review the visuals that I'm sharing in the wook.gg URL. Will bring you to the Wook Discord server and the voice chat. I currently have my screen being shared there. I made a couple of uh, visuals of my own where I just combined a couple of data points. So I have a chart that I'm looking at with the University of Michigan's Consumer Sentiment Survey and also the personal savings rate. So the picture this paints is pretty grim. You've got savings rates just 20 basis points above the all-time low, which was recorded in the housing bubble go-go years, July '05, when it was 2.1%. So the October data point was 2.3% savings rate. That's after you pay all your taxes and incur all your spending, what percent of your income is being saved, and it's extraordinarily low, and that goes back to 1959. So if that consumer spending sticks in November, which we'll talk about in a minute, then you might see an all-time low print for the savings rate. In fact, I'd be surprised if you didn't see all-time low print before this changes direction. And then you can see the sentiment data, which, if you've been following, you know that the University of Michigan sentiment's been quite poor. There's argument, should you use the conference board? I mean, both of them I think are fine. There's a divergence between the two that had broadened out a lot over the last, really since the pandemic began, where University of Michigan has been more depressed than conference board. But I think the story still is, if you look at consumer confidence and or consumer sentiment, it's really at levels that you don't ever see outside of a recession. But it's really a mixed signal, right? Because the data show spending is still holding up, right? So let me kind of read a little bit. The sentiment survey finds that, quote, along with the ongoing impact of inflation, consumer attitudes have also been weighed down by rising borrowing costs, declining asset values, and weakening labor market expectations. So I'm going to do the old what's his name, Lee Korsko, the football announcer, not so fast, because then when you look at, and I'll jump a little bit ahead here, a couple other data points, for example, delinquency rates on credit card loans. Yes, they've ticked up slightly. However, they're meaningfully below any level seen pre-pandemic over the prior decades, over multiple decades. So consumer credit card delinquencies, while up from the bottom, are still far lower than they were before the pandemic at any point in the last 2 decades. So while it's trending in the wrong direction, the absolute level is still extremely low. So that's maybe not trending in the right direction, but it's still a sign that consumers are okay, right? They're paying their credit cards. It's less than 2% or around 2%, delinquency rate. And then on this other measure, again from Federal Reserve Board of Governors data, is household net worth as a percent of disposable income. And again, going back to just after .com, going back to '02-ish, you see that yes, it's off the highs earlier in 22 and at the end of 21, but it's still that household net worth as a percent of disposable income has never been higher at any point in time uh, preceding the pandemic and in the prior decades. So while you've got this poor sentiment out there, you've still clearly seeing a willingness to spend, a capacity to spend in aggregate, and not too many red flags if you're a financial institution when you consider that, sure, if delinquencies are rising, they're still absolutely at very low levels. So my final graphic that I have before I toggle over to some of the Wall Street Journal economics discussion from today after today's jobs report that I'll talk about before I open up the conversation is looking at a couple of measures. So looking at that job postings on Indeed, once again, look, you see it's up 50% still from pre-COVID levels. It's actually ticked up slightly in recent weeks. So, while some will argue the JOLTS data is inflated, it does seem like with a more live, dynamic metric like the Indeed job postings, that there's still a whole hell of a lot of jobs out there and not enough people to fill them. And we, of course, got the massive rally a couple weeks back on that weaker inflation print, which in the blue line here you see this is the trimmed mean personal consumption expenditure inflation rate. So that is from the Fed in Dallas, and it's basically let's eliminate the high end and low end outliers from the data set, and what does the PCE look like when we trim those out? And yes, it's inflected downwards. So the trend is no longer going in the wrong direction; it's going in the right direction, right? The Fed wants to get back to 2%. So it's still though, right, above 4.5. It's still very elevated. And I think the question mark becomes, when does it get back to 2? And of course, that's the magic question nobody knows the answer to. It will be interesting to see in a couple weeks where the Fed uh, believes it will get to by the end of next year and then by the year after, right? So there's definitely a tug of war in the data going on. We mentioned the consumers having a lot, like you have mixed reporting of some people saying all of the excess savings has been eaten through, whereas on the other hand, there's commentary from, say, Bank of America and other bank CEOs saying that they're, and I didn't include the checkable deposits visual, but you can see that the data show there's a lot more money sloshing around in consumer checking and savings accounts than there were pre-pandemic still. And while that may be an aggregate figure and it may not fully capture the folks that are maybe not feeling so good on the low end of the spectrum, the Bank of America still notes that even their lower end consumers, um, if I can get the quote right, so I don't misspeak, this is Brian Moynihan, which if you missed my tweet earlier, I heard from an employee of the bank that they actually have put a company-wide hiring freeze in effect, effective immediately as of I think it was either last night or today. But it's a pretty broad hiring freeze that they've just implemented. So again, things change, right? And things sometimes change quickly. But at least going back to what he had to say 6 weeks ago, the bank's customers continue to spend freely using their credit cards and other payment methods for 10% more transaction volumes in September and the first half of October than a year earlier, and that customer account balances remain higher than before the pandemic struck, and that those with the smallest balances were about 5 times higher than before the pandemic. So overall, things look like they're still in a decent spot for the consumer. And then early data coming in for holiday sales, right? We've got early results from like Black Friday shopping, showing in. Look, you have different measures. There's always noise. You had a couple different folks being cited in the Wall Street Journal about Black Friday in-store traffic being up 7% year over year per Retail Next. But their data show only a 0.1% increase in in-store sales. So you may have had more shoppers, but the average shopper is spending less. On the other hand, you have another firm saying, well, traffic was actually up almost 3%. And then MasterCard, which, right, you think of the banks and the payment networks having pretty good insight into what's happening. MasterCard saying that in-store and online retail sales across all forms of payment rose 12% year over year on Black Friday. Now remember that 12% is a nominal figure. So while 12% more dollars might have been spent in real terms when you adjust for inflation, it looks a lot less impressive. And then Adobe Analytics, e-commerce was only showing a 2.3% increase. So maybe the truth is somewhere in the middle. It overall, on a nominal basis, looks like spending increased, but I think on a real basis, it's a little less impressive, at least from these early signals of what people are spending this holiday. So we'll have to keep monitoring that. I think the kicker and the takeaway is that if there's a recession to be seen, the consumer has yet to feel it, and it will be important to monitor as housing prices continue to decline and as job losses, which we'll get to in a minute, seemingly will start to ramp in 23. What then? Will the consumer be as strong? So, okay. Last set of some visuals before I move on to open it up. We had the oh, okay. So we had the jobs report right out this morning. So there's like conflicting data going on. You have a household survey and then you have a payrolls portion. So inherently, I may only be one person. I could have multiple jobs, but I'm only going to get marked as, a working person like one time in one survey, but I could get chalked up two or more times in the uh, in the payroll survey, right? So I am sharing a visual from Eric Basmajian, which I thought was good. It shows let me put my webcam down. It shows the non-farm payrolls, right? So the number of jobs versus the employment level, the household data. So there's been a widening spread over the course of the year where payrolls continue to be pretty darn strong, but the actual employment level has started to deteriorate more so. So could it be that there are more people working multiple jobs? Anecdotally, I know whenever I go into retail stores and I'm at checkout, I try to strike up conversation. I've heard multiple employees say just that. Oh, I've got to go work, at XYZ after I get done with my shift here at Burlington, for example. So there could be more of that going on where folks who are feeling that pinch are taking multiple jobs in order to keep up. And that is where you're seeing a little bit of a disconnect. Um, there's also been in the Fed, not the Fed, the Wall Street Journal included that too. But um, there's also been like the types of jobs that are still uh, sorry, toggling between screens here and a lot of information. Okay, so the change in employees by sector that came out this morning, and you can see where is employment still hot, where is it cooling? It's definitely cooling, going back to what we said earlier about general merchandise stores, having too much inventory and the change in employees by sector, that was the sector that was the weakest. You also saw warehousing and storage see a decline in workers. Some more goods oriented side of the spectrum, your non-store retailers, furniture stores, electronics, appliance stores, clothing, accessory stores, those all saw some jobs shed, whereas on the positive side of the spectrum, more service-oriented related spending, food services, healthcare, social assistance, accommodation, amusements, recreation, personal laundry services, all of those adding jobs. So it's a continuation of the mix shift back from goods to services that's going on. And it makes sense that the Fed is seeing the weakening in the goods inflation data, but that the inflation in the services looks like it could be more embedded. So there's definitely a lot of moving parts under the surface to consider. Um, and what else? Yeah, I think that there's also the point on the manufacturing side. Had our first reading from the Institute for Supply Management earlier this week on the first of the month. ISM puts out its Purchasing Managers Index, so it surveys what the purchasing managers are seeing and hearing and what's going on in industry. And the overall index marked its first. It's a diffusion index, right? So if it's above 50, it's expanding. If it's below 50, it's contracting. And it came in at 49, which is a little worse than expected. Some of the other PMIs, the Chicago PMI came in very weak. It was like 37. And look, you see people posting things like every time the Chicago PMI reports under 40, it means we're going to be in a recession. And I think the problem with a lot of these is there's so much noise in this post-pandemic era that you have to throw away a lot of these notions that, oh, just because there is an inverted yield curve, there must be a recession. Just because there's weak PMIs, there must be a recession. Now, there may still be, and there very well will likely be a a weakening in economic growth, right? The Fed's been clear they want to see below trend economic growth. They need to see below trend economic growth in their view. So we're seeing that happening for the manufacturing side slowing. And if you missed the conversation on Wednesday where we had our open mic, there were several kind of good examples shared of how folks in industry, like in metalworking, we're seeing that hey, we're finally resolving these supply chain issues. And the ISM data shows that the deliveries index indicated faster shipments from suppliers. So you have your anecdotals, you have your formal reporting, all kind of agreeing that we're easing those supply chain bottlenecks. Price pressures are easing, especially on like the raw inputs and commodities and goods side. But what about the services side as the consumer keeps spending? So that's about all I had for the prepared material today. It's 4:44, so I went a little longer than I had promised. I apologize. But I would like to welcome up anyone who'd like to chime in, talk about what they're seeing, in their personal economy that is in line or differs from kind of the data that I've shared in the discussion today. There's no right or wrong answer, right? We all are doing our best to understand where things are going. Um, but yeah, Joe, what do you
Yeah.
got?
I mean, we have some fun on the ground research coming out soon. I'm still putting that together. But, Rod, maybe you want to explain to people what you just did yesterday and what your thoughts were on that.
Yeah, sure. So not in line with this, well, not wholly in line with this discussion, but one of Wook's investments, PLBY, owns a lingerie and sex accessory retailer who opened a store in Tampa last night. So I attended the store opening. I took some video. Gonna finish up that product to post it to our YouTube to just kind of share that. But more broadly to like what is what exists for. I mean, we are trying to share crowdsourced research from ourselves and also from folks that we want to be part of our kind of information network. And I think going to a store, if it's a retail business, and seeing and getting feedback from consumers, their perception of the brand, what are the stocking levels look like in store. Um, there were some lines outside of the store. It wasn't as impressive as earlier in the year when I attended their Miami store opening, which obviously the economy has for the consumer has cooled a little bit since then. But yeah, I think that's a good example of like on ground due diligence that a retail investor can conduct. It doesn't require you to have any unique skill set. You might need to have some idea of what you're trying to look for and what you're trying to ask and suss out. And but yeah, that was something that I did last night that will get uploaded soon.
Yeah, that'll be fun. Hopefully, we can do more um, on the ground kind of research. I think that's really fun to get out there and film stuff on the spot. I know this was your first time doing something like that, so hopefully we can take what we learned this time and make it better the next time. But I see Jimmy has his hand up. Jimmy, go ahead.
What's up, Joe? What's up, Rod? Happy Friday, guys. Want to give a quick shout out to the bunny. Is hopping pretty hard today. So I think we're all just a little bit happier with that investment for now. Um, this is also anecdotal, but you mentioned the state of the consumer, the state of the retailer. Um, some narrative here. When Biden decided to extend the student loan moratorium really on payments for another half year. Um, I think particularly among Gen Z, the lower middle income consumer, and even some high end that are saddled with substantial amount of debt. Um, the psychological impact of having 6 months of breathing room, particularly through the holiday season, and not worrying about that cliff coming in January, um, maybe that brings more people back to shopping this season, right? Maybe we have a slightly higher volume or slightly better holiday season. And that's not to say that next year is not going to be difficult, that the comps are not going to get much easier, that we still have everything we have to go through. Um, my wife is a analytics manager at Nike, so I try to stay away from stuff she's saying, right? I don't want to go to jail and like get insider information. But I think the general trend in retail that some have pointed out is like every year the holiday season starts earlier and earlier, and yet we still saw some decent, you know, Thanksgiving Black Friday numbers. Now on a real basis, um, clearly it was down just because of the way that inflation has trended this year. But as consumers, we're still psychologically just to see some of those numbers up. Um, the bottom hasn't fallen out. So maybe in the near term we still have a bit more of a tick up.
Yeah, and I think
And then
what's
yeah,
interesting there, Jimmy, is like you have that thus serving as incremental stimulus for the consumer, for at least the
totally.
consumer who has which flies in the face of what the Fed is trying to do. It just makes their job more difficult.
Yeah. So we'll see. We'll see. But on the margin, that is a positive. And speaking of kind of primary research and due diligence, there's a couple of Lovers locations in Portland, and I drove by one. It looks so sad. The lights weren't even on. There's 50% off. You know, stickers hanging from the front window, and so I am glad that if they rationalize that, if they shut that down, I think that's additive to the brand. I still think about the original guidance that was given and withdrawn after the first quarter. And certainly there's a lot of lower margin, lower quality revenue component to that. But I do think just between the third quarter report, the capitulation, the sentiment, the small caps, the hated names have trended higher since. And in the near term, I still, see sentiment going from very bad to a little bit less bad. And directionally, between the short interest and no institutional names in the name, there are. I don't think there's a Santa rally, but these names can squeeze much higher. So a day like today, where we got good volume too, um, across a bunch of small caps, um, the market's extended right here. But for these smaller names, I think the path of least resistance in the near term is higher. But you got to deal with these 5-10% days on the regular. I think you guys are all aware of that. So we'll see how it is. I'm trading it like a maniac, but I like it here. And yeah, that's all I got. But it's a good day for me. Good day for your portfolio too, hopefully.
Yeah, I would push back a little bit on the sentiment point. I mean, I guess if you're talking specifically about that one stock, that might be a little different. But I mean, the fear and greed index, right? Like it's kind of back at uh, close to extreme greed levels. We've had these, bear market rallies all year where every time we rally and we get back toward the top, like we got back toward the top in August, or not the top, at the top of the rally, people are all, oh, new bull market, bear market's over. We're hearing that again now. New bull market, bear market's over. The VIX is back under 20. Last time that happened, it wasn't so good. But it doesn't seem like there's much fear or concern. It does feel like there's a lot of complacency in the market. Just trying to, after the Powell call, for example, I tried to tune into a lot of different spaces and hear what the sentiment was from the participants in those. And I would say that broadly, it was almost euphoric. It was, hell's yeah, we're back, baby. It was, we're returning to only up gang was a lot of the sentiment that I
For sure.
heard.
And nothing
Uh,
changed. Nothing changed. In fact, the market ran before he even got on stage. But, again, coming off of either all-time lows or some very, very low levels across the indices, when you're looking at it at a slightly shorter time frame, we have a lot of trapped bears as well as bulls. My trading account is over 100% net short right now. And names like Playboy have really helped me stay afloat. Obviously, I have lots of long exposure in my Roth and stuff, but yeah, we got to be careful here. The market is very complacent.
Complacent. Yes. Well, there was a shift today, right? The stronger so going back to the conversation I had, the payrolls report was stronger than expected, right? It was expected to add 200,000 jobs. It added what, 260 some odd, and October was revised up. And we're back in that weird situation where good news is bad news, or at least for much of the morning, it was bad news to Mr. Market at the index level. People forgot very quickly. So, yeah, it still seems like there's not a belief that the Fed will be hiking as far as the speakers keep saying and for as long as the speakers keep saying, which they may not, of course. They were certainly nowhere near where expecting us to be where we are now a year ago. But I'm very interested to see after this, payroll report. Basically, you saw also, and I didn't get to go over it in the remarks, but I'll flag it on screen. It was Jason Furman, who is a Harvard professor, that noted, at least in his view, quote, the biggest news in this release is large upward revisions in wage growth for September and October and a big number for November. This is the second time this year we've seen uh, average hourly earnings revisions like this, dashing the hopes that maybe nominal wages growth was cooling. So it's like, that's good from the very in worker oriented lens, like, yeah, they're getting paid more. That's great. But on the other hand, if the Fed is looking to combat inflation, you have these cross currents of, yeah, goods prices are dissipating and you've got some cooling on rents. But if wages are continuing to grow this strong, it doesn't seem to square that you can, without inducing something to destroy that demand, right? By keeping rates tight. And Powell, I think the dovish thing is he was perceived as saying, I don't want to over tighten. Whereas at the November presser, I think he said that they would, if they need to over tighten, they'd be biased towards over tightening. And I think the slight change in the language that I don't want to over tighten, but that they have over the last couple of weeks, I think, been pretty consistent. He and the other speakers that just because we go down from 75 basis point hike in December to 50 does not mean that it's a pivot. It's not a pivot. That's not what the word means. Pivot would mean, twisting from increases to decreases. I keep seeing people saying like, "Oh no, deceleration is a pivot." I don't believe that is how the dictionary definition would get it across. But yeah, I think that was interesting. Just kind of seeing how strong wage growth is, and that it doesn't seem to square that you can have really strong wage growth um, with inflation getting back. Because look, if inflation target is 2%, wage growth shouldn't be at north of 5%. I mean, that would be more consistent with the what the lagging inflation PCE is showing of that foreign change closer to 5%. So I thought that was another interesting point I forgot to bring up.
Yeah, for sure. I think very quickly, as soon as we get the non-farms payroll at the open, clearly there was a bid for retail. Maybe the idea that there's more money in people's pockets or that people are still earning money, right? I think when I look across the landscape today, I think we're all in agreement that earnings estimates are still too high on the sell side, but we kind of know that's a lagging factor. I don't know where the whisper number is, but whether you're a macro investor or you're a long short hedge fund, it's clear that there's still a lot of trap shorts that were shorting these companies into the ground, and there's going to be some zeros, but when they're all clustered up in these baskets and people are only going on factor exposure, which is really killed Playboy. You talk about being in the mother of all unfavorable factor exposure type Companies like
Well, and you have an
yeah.
atrocious CEO. I mean, we can't leave that aside.
I'll still reserve judgment on Ben Cohen. I think it's a lifestyle job for him, so he's probably not an aggressive turnaround guy in the same way. I think
He's
he
not an
likes the
operator.
asset
You're right. It's a
base.
very cushy job
Yeah,
for him.
yeah, and we like the assets, right? We like the company. We like the bones. There's something there, but I think he likes he likes being the CEO of Playboy. And we talked about the ownership structure. I don't think that goes away. He would have to get hit by a truck. And I was just talking with someone today, like, let's say Ben Cohen disappears, the stock is probably up 25-50%. So the bias is still at these levels. There's just not a lot of active sellers. There's high short interest. There's a lot of people who are bearish in retail. Um, but we'll see where that goes.
Well, and you know better than the most that retail is over-earned extraordinarily so over the preceding
So
2
much.
years. So, I mean, there's a reason that a lot of these stocks are heavily shorted. And while that one-off maybe, whatever, let's not get too granular on that one company, but yeah, when you see these crazy rips, right? You had two of the biggest up moves in Nasdaq in the last decade this past month. That is not something you see in healthy bull markets. That's something you see in bear markets. And I understand a lot of younger investors haven't really experienced that. I'm not that old. I'm 33, so I was still very young and in high school, kind of following along and getting my feet wet in the late 2000s. In that particular kind of run up and then crash. But yeah, you're right. There's people getting, their faces ripped off if they're short. Carvana's a zero, sure. But along the way to zero, there's going to be a lot of 20, 30% plus rips that are painful to stomach. And, shorting is not for everyone, clearly. I think most retail investors will be better suited just indexing, really. The vast majority would be much better suited not trying to actively uh, manage, because unfortunately the data show that most end up selling near the bottom and then buying near the top. And they, on average, the average retail investor underperforms passive and underperforms, active managers, professional managers tend to underperform passive. Active retail investors tend to further underperform those active managers, at least from the data I've seen. Which again, we're obviously, those of us listening to this conversation are likely of the view that we're going to be in that different bucket, or maybe we're only using a portion. Some folks are only using a portion of their account to, actively trade or invest or speculate, and the bulk is in target date or on passive. But you know, it's obviously depends who you are and who we're talking about, right?
For sure. I just got one more data point for you. It's interesting looking at across the similar sets of meme stocks and where we are in the rally and how late we are. It's almost, AMC and Ape had a big rally yesterday, I think, or the day before, and it's like almost to a T at the very end of a bear market rally squeeze where hedge funds are getting blown up, people are caught off sides. You get these rallies right before the next leg down. So, yeah, overall, it's still, we're going to have to take a wait and see approach. We're definitely not out of the woods, but could we grind up to 4150, even 4200 by the end of the year? That's not out of the picture, in my opinion.
I expect that to be crushed in 2 weeks. I could be wrong, but I don't think it is good for the Fed to see that. I don't think they would want to see that. I think that the data they will report in the SEPs will change that quite quickly. And going back to the thing I led off with, perhaps that's part of the thinking of Powell sounding a little more, or being perceived as a little more dovish earlier this week, is to build more of a buffer for that. But who knows? There certainly is evidenced by the low VIX and the relative uh, valuations. There's still, I think, a lot of complacency. There does, right? If the market really thought there would be a recession that's anything more than a very, very, very modest one, then valuations would not be near where they are today. At the index level, again, if we're going to talk about single securities, it's a very different
Mm-hmm.
conversation. But
I mean, I think we're in for a deep recession. Look at the tens and twos. Look at corporate earnings. Look at credit at all-time highs. There's a lot of factors that we have to go through some real pain. But this whole really since the early to mid-October timeframe, where the U.S. dollar peaked, you had all these narratives. You know, the other currencies were getting smashed. Everything has been an inverse dollar trade. 10-year bonds are now back to, according to Hedgeye, their neutral trend, but they're at about 350, so they're right at the low end of that range. Risk assets are at the high end of the range. VIX is at the low end of the range. Even small cap, volatility, right? RVX is sub 25. NASVOL is like 26. The market makers crushed everyone, right? They said, fuck your puts, fuck your calls, fuck your 0 days to expiration. The market was pinned all day. And without just going into a bunch of random things, it's this is a critical juncture. But my money is still that over the next 3 to 6 months that we grind lower.
Yeah, you mentioned tens and twos. I pulled up on the visual the 10-year 3-month spread, and that is still trending further and further negative. The data point for yesterday was negative 80 basis points, the spread
Yep.
between the 10 and the 3 month. So historically, again, this is why I am reluctant to automatically go by, just because these things have happened before, it does not mean they must happen again. And the pandemic response and kind of where we sit post pandemic is certainly a once in a century situation. We had a very, very, very brief recession where the government ended up shifting many trillions into the pockets of consumers. People didn't lose their jobs. People, in fact, saw their wealth and their balance sheets massively improved. And, as we were discussing, on net, there's still a lot of dry powder. There's still a lot of income. And it all comes back to me that until you really were to see some serious negative wealth effects from housing and or people actually losing their jobs, and which is not, we don't want, obviously, we're not trying to sit here and root for that. Obviously, the Fed expects there to be an uptick in unemployment. In the September SEPs, it was, I think, 60 basis points, which is like 800,000 if I have my math right. What I believe is going to happen is that ticks higher when they report in December, for the year end 23 at least relative. So, I mean, we're still at what, 3.7? The natural rate they believe is higher than that. So it's a very weird situation. I know that people love to knock Chairman Powell. I think I've followed the guy very closely for years, and I honestly think he does a pretty good job, and I think his intentions are good. I don't think he's some evil lizard man who's trying to, work on the whims of the rich only. I don't know. Like, maybe he's pulled the wool over my eyes, like SBF's trying to pull the wool over everyone's eyes. Um, but hey, Paul, and hey, by the way, GA, I know you've been up here as a speaker. If you wanted to chime in at any point, go ahead as well. Crickets?
Paul, what's up?
Sorry, I'm trying to figure out my headphones. Give me a sec.
But all right, so when I went to the mall last night, granted it's a Thursday, and it was, after it was 6 o'clock, I was there for an hour or so. There was not a lot of foot traffic, or at least not what I would have thought I would seen, this time of year. And Joe is going to get the video, and we'll kind of put that out on the Wook YouTube sometime soon, and you can kind of see some of the different storefronts. Now, this is an upscale mall too. We're talking about a lot of luxury brands that are in the mall. There were a lot of empty storefronts and just not a lot of not passengers, not a lot of foot traffic. So, just that little tiny anecdotal. I mean, going back to your point, Jimmy, of are people just shopped out earlier? I know, Paul, you mentioned whenever you fix your audio issue, you mentioned earlier in the week that you personally felt like you've bought everything you need to buy. What the hell else do I need to buy? I know I shared, and let me pull it up on screen. I didn't include it in the write-up, but there was an article in the journal last week that I'm pulling up now, talking about expectations of a lot fewer gifts. Um, so this was a Deloitte survey in early September asking consumers. This is almost 5,000 consumers, how many gifts they plan to purchase, and you can see that 2022 is quite the outlier over the preceding decade. The average has been maybe 13, 14 gifts over the last decade, and on average, and this year it's down to 8. So a big decline in the expected amount of gifts. So people are going to be spending more on experiences in line with what we've been seeing broadly. Like it's hard to, I mean, I guess you could gift cards, right? There's a good deal on Southwest gift cards at Costco if you want to get 10% off. But thinking about goods, it's like people have already acquired most of the goods they need. So what else is there to buy? And maybe that's why you're not seeing as much foot traffic in some of these malls. I know the data I shared from an aggregate on Black Friday was that there was a slight increase in foot traffic year over year, but again, that the nominal spending might be up, but the real spending might not be. And as we get further into the holiday, we'll get a better picture of it. But Paul, your audio working?
Yeah, I'm here.
Okay. What do you think?
No, I mean, I said a lot of that stuff on Wednesday,
Yeah.
but the thing that I forget who it was, I think it was somebody else because I was listening while I was walking my dog. Um, oh, I think it was actually you. You were talking about like consumer sentiment, but I think what a lot of people have to realize too is it's not just consumer sentiment, but it's small business sentiment. And I forget if I find it, I'll pin it. But
Yeah.
it's uh like if you I forget what it was. I think it was like was it Forbes or somebody else recently, like maybe like a month or two ago, probably like 2 months ago. They're saying like how far small businesses have actually fallen behind on rent. Um,
Mm.
because like they can't afford rent, and small businesses are obviously supported by normal people for the most part, um, and other small businesses. So that's just like one other factor that like people should look into besides like just how the consumer is doing. It's like also how's the small business doing because those are kind of not it's not a one to
Yeah.
one correlation, but they're pretty intertwined.
So I pulled the visual up of what you're talking about, and this is the end of October 31st. The headline in Bloomberg is more than a third of U.S. small businesses couldn't pay all their rent in October. And it varies a little bit by state, but it was about 5,000 business owners, and the survey was only conducted a month and a half ago. So to your point, that doesn't feel uh, that healthy to me. I don't know offhand what the norms are for that sort of a survey, but that does feel awfully high. If rent is like if you can't pay your rent, how do you continue your operation, right? If you're being evicted from your storefront, it's hard to run a business. Um, so definitely not a good data point.
No, and that can also be like a function of like I'm not going to say that every small business that was a part of that survey is a great small business. You know what I'm saying? But there might be a function of like labor shortages, so they actually can't even get people in the door to service them. That helps make them money. That helps them pay rent. You know what I'm saying? Um, and it's also might be a function of just generally people might just be cutting back so they can't afford to pay that rent. It's there's a lot of variables that like a lot of unknown variables, right? But if you think about how many small businesses there are in America, I'm sure they're split against a lot of those variables in some way or shape or form. Um,
And I know I mentioned on Wednesday, but I'll reiterate it that at least in the ADP data, it showed that the payrolls were being added in like medium businesses. Jobs were shed at the bottom, the small businesses, and jobs were shed at the mega businesses, 500 plus employees. But 50 to 5, that's where the job ads were being seen. Just that one data point from ADP this week.
oh yeah, because even today, I was at the business that we acquired last week, And, like not more than like 100 feet down from it, there's a Subway and a Dunkin' Donuts. And there's signs for reduced hours, and there's signs for, you know, we're looking to hire. And those have been up there for a while. Um, so it's still a function of, yeah, the people at the bottom are still feeling pain. And this shouldn't be ignored.
Yeah. Anyone else is welcome if they want to request to speak and chime in, share what they're hearing, seeing. It does feel like while
If anybody even has a hunch on why Peloton moved up a ridiculous amount today, let me know because I I'm still scratching my head on that one.
Maybe just
wow,
because it
maybe
went
even
down.
highs. It's at its highest point in 6 months nearly. It's about to surpass the August peak.
Mind you, it still has a $400 million burn last quarter, so there's that.
Yeah, there's been a couple of names like this. You even look at Gap, another retailer, kind of just in the last week or two, shooting up and testing like the August bear market rally highs, even though the core fundamentals are not great, especially in any short period of time. It's just people caught off sides, right? It's depending on where your basis is in Peloton, there's a lot of trap shorts that got in really late. They're not down. They're not short from 200. They're probably short from 10.
Yeah, Gap is interesting though because Gap was in the tubes already, and I think just estimates were so low to begin with that when they did post results, it just wasn't as bad. Um, Peloton was interesting though because leading into the print, I've been so negative Peloton this entire year because I'm like, if you're looking at the consumer, again, $4,000 treadmill, um, $3,300 rower, $2,800, 25 to $2,800 like premium uh, bike. Who's still paying that? You know what I'm saying? But like a bunch of good news comes out with like cutting costs, outsourcing manufacturing, cutting labor, SG&A, like getting
They're
deals with
outsourcing
Dick's.
manufacturing. Didn't they acquire a manufacturer?
Yeah, Precor. Yeah,
Yeah.
they were
What
gonna build. They were gonna build a plant here in America in Ohio. Uh, but they scrapped that for obvious reasons. But the thing is, like, once the print happened, it was it was still bad, and it dropped 15% pre-market, and then I guess people were just like, all right, cool, buy it, and then like it's just been up since then, like what you just said.
Yeah, just I'm looking at from short sites data at least the short interest as a percent of the float is around 15% for their data at least. And to to Jimmy's point, it does look like there could have been some incrementally added at lower levels. So, I mean, yeah, maybe some people are just getting squeezed out. I haven't looked at the results, so I couldn't speak to if there's actually a fundamental improvement to justify it. It does feel like a lot of I don't know. There was definitely some crap that floated to the surface today. It felt like not that I want to call my investments crap, but that one company we were talking about before being up 15%
It's
on
a
nothing.
gem.
Well, I mean, I think the assets are one of a kind for sure, and unfortunately, I think it's led by a buffoon who is a liar. But we don't need to go down that rabbit hole. No pun intended. But okay, so yeah, small businesses struggling, consumer, some of them are tapped out, but a lot of them it seems like have a lot of money still. We look at I know if you look at like the Fed, like the household net worth is still really high, even though it's off the highs. Um, and when you just think about how much higher homes are still 40 plus percent from pre-COVID, that is a huge wealth effect. If you have that asset and now you feel like you can continue to spend because you've got that backup, whether if you were to tap that equity, that's why I think the big items are job losses and really started to see housing prices come in. We saw on the commercial real estate side yesterday, right? The Blackstone Real Estate Investment Trust seeing that uptick, and let me pull the story so I don't ruin it. Um, but they're limiting withdrawals and here's the letter they sent that they're limiting withdrawals. They received repurchase requests equal to 2.7% of net asset value in October, approximately 1.8 billion. And they did receive approval to fulfill those. However, now that they've exceeded their redemption requests, uh, the 2% monthly and 5% quarterly limit, that they are basically pausing. They won't be fulfilling those repurchase requests. And I know that sent BX down a lot yesterday. I actually didn't look at it today, but like commercial real estate, right? We've talked about that kind of being, we're talking about residential a lot, but commercial real estate seems to me still very elevated, and there seems to be a lot more downside in real estate broadly.
Yeah, I'm not touching real estate with a 10-foot pole. I think we've chatted before. I worked as an institutional investor in REITs for over a decade, and this year has been uniquely difficult. When the 10-year, so risk, for even for the non-dedicated investors, REITs and commercial real estate was always seen as maybe a bond plus, where you're clipping a coupon and you get some capital appreciation. There's some other added features, but right now the equity premium is just not there. You can get 2-year notes at what, 4.5%, whatever it is, and you'll be getting it, more of that in about a week or two, and then in another month or two. So the cap rates for real estate have not adjusted upward. Some of that is just because of lack of transactional um, volume, right? Because everyone's stuck. There's such a wide bid ask spread. A lot of my colleagues in the industry, the most notable sell side analysts from Citi, just gave up the gig because there's no banking revenue, there's no secondary volume, revenue. That the whole mechanism that greases the wheels that keeps those industry going has been at a standstill. Um, I got to think there's going to be correction on rents and interest rate financings. A lot of malls continue to go bankrupt. I think there was just one in New Jersey that went into default. Um, it's a very tricky situation. San Francisco, there's no office demand. In some sectors of real estate, there's always a clearing price, multifamily, let's say. But in other sectors, there's just, if no one's there, then no one's there. So it's quite a, it's I'm a little, I wouldn't say scared, but you have these moments in time where a lot of things have just transpired, and you have a class assets that you think are never going down, and then the public market will, adjust it down 40% for some of the best high quality multifamily landlords out there. And then what do you do?
Yeah, and I know at least on the consumer side that mortgage rates have ticked down with treasuries rates coming down a little bit, right, over the last few weeks, at least from the highs. But it's like, well, what price change is commensurate with a doubling of rate from 3 to 6%? If prices are flat, that's a it's a massive real increase. Uh, in the context of rates. So it just feels like, and you obviously know real estate, having worked in the space for many years, Jimmy, better than I do. Just it feels like there's a big lag still in how much further there is to come down. I saw someone on Twitter earlier today noting they had a conversation with a CEO in the space, and that the CEO's expectation was another minus 20% for real estate values, um, which what happens, right? What happens to consumer spend if real estate values come down 20%? It would surely have an impact. I don't know what that impact is.
Yeah, no doubt. And I personally like Jerome Powell, but as far as the Fed and some of their disingenuity, it was interesting when he was speaking at the Brookings Institute. He was very specific to reference OER, owner equivalent rents, and how that's inflected and how there's a lagging impact. And so I think he conceptually knows that if he hasn't broken parts in the market, he's definitely stalled some critical cogs in the infrastructure. But the counterpoint would be that in the middle of last year and even before, when things were appreciating and you already could see if there's a 6 to 12 month lag effect on rents and home price appreciation, why that wasn't a bigger consideration. He clearly was riding the wave that was 2021. So now we have to deal on the other side. But yeah, we might have another 50 bips, another 50 bips in just a couple of months, not even. And then what?
Yeah, but isn't the timeline right now 50-50-25?
Yeah, and I'm not sure, is that second 50 coming in January? Because there's an end of January meeting before the March meeting. So if he goes 50 in December, um, before we even get to earnings season, or we're right in the middle of like Q4 slash 2023 guidance, we might be 100 bips higher.
I actually don't know off the top of my head.
So yeah, it's Feb 1st. So you've got kind of surprising how high I think the CME FedWatch tool is still pricing 23% chance of the 75 in December, which I don't know. Having listened to everything over the last few weeks, I don't see why that's so high. Especially having heard the chair this week. But it's still priced 50-50 in Feb then. Um, the terminal is still, I think it went up. I saw it went up what was it like? It went up a little bit today the uh after the report, the jobs report this morning, but it's still just around 5 for the terminal, which from what they've been saying doesn't seem right, but yeah, we'll have to see. But yeah, that would be 50-50-25 would put us, right at the 5 to 525, right?
Yep. Yep. Hey, Rod, is Wook Capital involved in any cannabis investments? Have you looked at that recently?
We've only disclosed the one position publicly. Uh, I can tell you that I personally have not looked closely at cannabis, although it's very interesting, right? I just don't know if where's the value, where's the profit pool for cannabis? Because I don't know that there's like really differentiation in the product so much in the production of it. Is it just going to be a distribution play? And if so, why won't the big tobacco companies be the ones who can kind of tap into that and wield their networks? But I really don't know a ton about the industry. I haven't done any deep
Okay.
dives.
Yeah, I mean,
That's
it's
my
it's
that's my
really
wheelhouse.
all. Is it awesome, man? Yeah, I've been in MSOS, even some of the LPs for a long time, up and down. But again, it's legislative season. This is super high volatility, mostly retail money now. It's an access to capital issue, but you're definitely getting some signs of life over the last couple days. So my hunch is that someone knows something. The fundamentals are still not great. There's a lot of price degradation. The illicit market has been an issue. All these companies overexpanded and they're not hitting their pro formas. The cost of capital has gone up insanely. You're talking about debt costs. You can't even get financing, but you have floating rate debt at 15%. Realistically, the return that's needed for the equity shareholder is about like 30 or 40 or 50%. So it's just scared everyone off. They trade on junior exchanges. It's not really an institutional allocation yet. But these pops are definitely juicy for the retail trader. But it's very socially driven too. So as far as socially sourced, crowdsourced research, There is a growing community of people that follow state by state fundamentals, and they track a lot of what's going on, and they're pretty well versed on the legislative side too. But it could be a rug pull. It's been a rug pull.
No, this whole rally in cannabis has literally been on the hopes and dreams of what verbiage is included in bills. That's literally
exactly 100%. Yeah.
And the thing is, like, this is nothing new. This has been going on for the last 4 years, and that's why, like, most of the tier one MSOs, I don't even touch Canada. Canada sucks. Are up like what, about 100% now since the lows, and again, that's on nothing more than just what could be included in the bill. And considering how I've been through that rodeo before, I'm like, I'm not going to go ahead and start betting on what words could be in a bill, especially, you know, come January, and just how slow these politicians move. But no, I think honestly, cannabis right now, you know, even after this rally off the low, is still the most undervalued and best, probably like risk adjusted return sector of the market, hands down. And that's for a ton of reasons.
So,
Yeah,
so
over a
Paul,
tail duration.
is it the actual producers that you find attractive? Like, I know I heard a thesis for, say, Turning Point Brands with, you know, their zigzag, product, right? For the consumption, right? That the burning of it, more burning, you're gonna, and obviously Raw, I don't think is a public company, but like the picks and shovels type play. Like, what are you seeing? I guess because I don't know the
That's the
space.
thing. You can go both ways, right? Like, so you have Canadian LPs, which I hate because the way the Canadians handle their cannabis market is vastly different than what the Americans or the Europeans are doing. I guess the Europeans are probably more on par with Canada, but America's is very different with cannabis. So when it comes to your, you know, canopy growth, your chill rays, like, no, I don't even bother mentioning them in conversation. When it comes to America, though, yeah, you have there's like tier one MSOs, which are the good ones, right? Your Curaleafs, your Green Thumbs, True Leaf, etc., who are doing great, right? They strategically grew where, um, you know, they've acquired dispensaries in states where they, you know, like mostly medicinal first, and then that's when they turn to become recreational, and they've grown that way. You know, they got their foot in the door, you know, to get a head start, et cetera, et cetera. But they are obviously handcuffed behind their back because, you know, they are still, you know, a scheduled drug, which, you know, banking wise, you can't do many things. That's why the debt is at ridiculously high levels, rate wise, and you know, they just don't have the same opportunity, especially for even like write downs too. Like that's one of the biggest thing, right? Like safe banking and like Section 280. It's like the way they can recognize expenses is not the same as normal companies. So in reality, their earnings, American-based companies, their earnings are artificially low. And when I say artificially low, it's because they just look at the same tax benefits that normal companies would because of that scheduled drug classification. Safe banking, you know, obviously they don't have like access to banks and stuff like that. So it's tough for them to get, you know, traditional financing. So they have to go to like other parties that, you know, obviously are more like loan sharks. But what you can do now, which is quote unquote safer, are your ancillary players. And those guys are the ones who cater to cannabis companies. So you have like one of the bigger ones, so which I had last year, but God, it's terrible now. Scott's Miracle Grow, right? They have a sector arm of Hawthorne. Hawthorne is the biggest provider of hydroponics, which cannabis companies use to grow indoor cannabis. Then you have like other ones like Hydrofarm, you have Grow Generation, which are other additional retailers of hydroponics, and you know, CEA, which is Controlled Environment Agriculture. You have smaller players like the Agrify, which is trying to become the tech-focused version of CEA. You have Urban Grow, which is again smaller down the pipeline, which I actually prefer a little bit better. And then you have like other ones like in the tech-focused world, but like it's like Leafly and Weed Maps, which have gone down in tubes as well. So you can.
I made a ton during the Silver Spike SPAC period, but I got the fuck out.
Oh yeah, I mean like those crashed hard, you know. And then you also have like not even the cannabis ones, but you have like the indoor grow companies, which technically their IP can be used to grow cannabis, and that's like your app harvest, your local bounty, stuff like that. So it's more so like if you invest in cannabis now, you like I mean like pure cannabis. I mean like the dispensaries, like the green thumbs, the MSOs, right? Um, you got to understand that that pain is going to be there when it comes to volatility because everything is riding on legislation. And if like a bill comes around and the hopes and dreams of verbiage coming in there for like safe banking, for instance, isn't in there, but the run up has happened, it's going to crash hard. And that's what happened actually this year because everyone was waiting for Biden and the Democrats to do something and they haven't done anything. And that's when a couple months ago when Biden was like, I'm going to ask what did he say? Ask the DEA or something like that for like, just to take a look to see if we can reschedule cannabis. And like, that's when the market shot up like 40% in like 30 minutes. So it's stuff like that where like, if you're going to invest in it, you got to park it. You got to know you got to park it. If you want to, you can play the ancillary ones only because there's like up listings in the actual markets, so you have like better liquidity. It's not just retail pumping it, but that's kind of what it is right now. And Canada, like, again, Canada, like I said, screw Canada. They don't know what they're doing.
There's so much more to talk about. Obviously, don't want to hijack the spaces and turn it into a cannabis chat.
Yeah,
but,
same.
the fundamental outlook, there's just too many moving parts, even operationally. And if you're a creditor, if you can't even underwrite that and lend your money, how could you do any better as an equity investor, right? At least a fundamentally driven one.
Fundamentals, what are those?
No, I mean
Super interesting. I'll need to do some more work on my own with regard to cannabis. I mean,
Mhm.
it strikes me as when, not if, but obviously, if you're wrong on
Yeah.
timing, what's
No, it's a when. It's a when because if you just look at like on my website, that's in my bio. There's a section on the right hand side where it's a cannabis index that I just like created from Google Finance just so people could just track it on their own. Year to date, it's like you could just see how down it was like right before Biden spoke, and you can just see the uptick from it. I mean, at the low, the cannabis MSO market was down like 60%. It was so bad this year. And mind you, this is down 60% on just the whole policy thing because underneath they're making money, they're doing well. It's just that again, artificially low because of what it is.
I just had two more quick things to add. I won't take up too much more time. So the descheduling is a big deal because there is a tax called the 280E, and it's a tax that gets taken at the top line, above the line, not as a traditional tax after net income. So this is a business that otherwise the tier ones can produce more than 50% gross margins, 30% adjusted EBITDA margins. So like this rivals, if not exceeds, many traditional CPG companies. But because of the onerous tax at the top line, it really kills the cash flow. Now, secondarily, when you think about the capex and the money that these companies have spent over the last couple of years to grow their footprint and to not really be monopolies, but to achieve scale, um, the problem with a lot of that is just interstate commerce, state by state. You can imagine, right? It's cheaper to grow weed in Colombia than it is to grow weed in New York. But because of the inability to move product across state lines, what a lot of the companies have had to do is go vertical in every state that they participate in. So you can see how it would be very, very ineffective and a lot of the capex in higher cost of production states if this was a more federal framework would just be completely uneconomical. So I don't know about the impairments on that capex, but they're playing within this narrowly defined sandbox. And the most lucrative locations are the ones where there are barriers to getting more licenses, right? There are barriers to things that protect margins, that protect the businesses. And so when you look 3 years, 5 years out, that future landscape, we know that the tier ones that have better balance sheets that have bigger footprints can probably work their way around, but we don't know how we get from A to B. And it could be up and down, it could be down and up. So there's not a lot of confidence. I don't have a lot of confidence in the underwriting.
That's really interesting. Just the idea of
Yeah.
regulation as a meaningful, obviously it's a barrier right now, but once it's somewhat, I guess, regulated and not Schedule One, I mean, it like tobacco, it ends up being a big barrier to prevent other players from infringing on you. You know, if there's a limited set of licenses and or storefronts, and you are able and positioned to acquire them. That's very interesting. I'll need to do. I'm just looking. I pulled up a couple of these indices, uh, and I was noting they're awfully low. This new Paul, is it New Cannabis Ventures? I linked over to this global cannabis stock index.
Yeah, new Cannabis Ventures. I think what's his name, Alan. Yeah, no, he's been in the cannabis market for ever. But no, I subscribe to him. He gives a lot of good information, a lot of good commentary on a weekly basis for what's going on. And his index, the New Cannabis Ventures Index, includes a lot of people. It's not just like America or Canada. It's just like a conglomerate of them. Where mine is just strictly America because I don't care about Canada.
Looks like he has an American as well, beyond the global. But no, it's super interesting. Thanks, guys. I don't want the entire conversation to be about cannabis, although for those who are going to have their weekend or who've already started their weekend, I hope that they opt to enjoy it responsibly. Um, it's 5:40, just a time check. I do think we'll wrap in about 20 minutes. So anyone who hasn't had a chance to come up and chime in, obviously a lot of the conversation we had was around the consumer, around where things stand in the economy. If folks wanted to share their perspective, ask a question, I welcome them to do so. Otherwise, we can keep talking about cannabis if there's no no other interest. But just a time check. I'm gonna wrap things up in about 20.
Man, if nobody else says anything else, definitely like to hear more about cannabis. Just because, hell, I've been, uh, you know, I've been in Afria, which is now Tilray now, or whatever, when their merger happened since, I don't know, 2017. I'd like to hear if no one else wants to talk about something else, I'd love to hear your thoughts about why Canada is why there's better things to invest in, or other companies to invest in, instead of, Canada companies.
Paul, you want to take a stab at this? I think we're
Yeah,
pretty aligned in terms of our overall view on these companies.
I think
But
so too. I mean, because the thing is, the way that Canada works is like the government kind of controls cannabis there. I don't have to say kind of, but they do. And the way they make the system work is that you basically have to sell it to the government, and then the government is allowed to then sell it out. So it's not like in America where like Green Thumb grows it and then they can just sell it from their dispensaries and you package them up into their brands, whatever it's like partnership brands like drinks and CPG brands. Um, there's like an extra added step in Canada, which makes them it's a hindrance to their business. But the thing is, like, you can't work around it. Like, it is what it is, and this has caused like a lot of illegal stuff to happen in Canada because like they try to bypass it, um, which doesn't work. And that's a lot of cannabis companies up there have actually, been sanctioned and had to be forced closed. The CEOs and COOs have been like sent to prison. Like if you want an example of this, just type in CanTrust arrests, and you can see like you can see how the CEO and the other C-suite people were like literally running backroom cannabis farms to hide from the government so that they could try to make more money. And they were a publicly listed company. How I know that because Bank of America took them public when I was there. My coworker worked on it. But the reason why I don't like cannabis in Canada is mainly because of that, right? Like you're having the government take part in it. That's limiting their ability to do free market business. And the benefit though is that they are a cannabis headquartered company, right? So they actually can be uplisted in America. So that's why they trade on the Nasdaq. That's why they trade on the New York Stock Exchange, et cetera. So that's why you get like better liquidity. And that's why big names, big institutional names are allowed to buy those companies. There might be limitations on like ESG because like they might have funds where it's like, oh wait, it's considered illegal here, so we can't buy into it. But for the most part, is access to capital is just much more abundant because they're based in Canada, but they trade on the American markets. Well, also in Canada, but just obviously more here. And the problem that you deal with here is that fundamentally the way that cannabis is run in America just makes more sense because it actually is a free market. There obviously are state regulations on a state by state basis that you have to abide by, but there's no one like telling you, like you got to sell it to us first, and then we can, sell it from there. It's like no. Like it's like you got to pay those hefty like Section 280E, like you know, uh, I want to call them tax hindrances, but just whatever. You got to pay to play essentially, and that's how you do it. But the thing is, the opportunity is much greater, right? Because you have a larger base of here, arguably, that in America smoke weed or take weed products. You have a higher acceptance rate of people who are like, hey, we do it already. We'd rather it be legal, but we can't. So you're kind of just waiting for a switch to turn on, because underneath everything is good for the most part. It's just that they're being held down, and that's why when you invest in American cannabis, it's not on the hopes and dreams that the underlying industry gets better. It's on the hopes and dreams that the switch will be turned one day and you're in it and you'll immediately recognize a pop, which is what happened over the summertime with the Biden press conference that they had. And in Canada, you're not going to have that, because what the Canadians are waiting for is for America to go online, and then they can start scooping up things and diversify their holdings to a multi-country base, right? Like Tilray's kind of done that in Europe, and other people try to do it like in Latin and Central America. But that's why cannabis is the wild, wild west. America is good. It's just waiting for the green light, which is policy. But no matter what, Canada, for the most part, will always have its hands tied behind its back with what it is allowed to do, not what is just waiting to happen.
So is the hope that there's a bill passed in the lame duck? I mean, I don't follow the industry.
That was basically it. Like they're still waiting. They're still waiting, basically.
Because I find it hard to imagine there's going to be some bipartisan bill passed in this new Congress where we sing Kumbaya and smoke joints together between the two parties.
Well, for instance, even New York. If you take New York, for instance, New York has passed, like New York, it's illegal. It's legal to smoke weed here and buy weed here. But the
Right.
problem is the legislation of New York has taken forever to hand out licenses. And then I'm gonna say, when I say forever, I mean like it's like over a year now, Jimmy, or something like that, right? And mind you, the farms that have been operational to support medicinal have been ramping up in anticipation of recreational going online. But the thing is, there's no new licenses. So like they're actually sitting on a shit ton of cannabis that they can't move because they're waiting for these licenses to be executed. And then even recently,
and writing down their assets in the meantime.
yeah, exactly. Yeah, because they have to, and which sucks. And then you have the local state government who are like, okay, you know what? We'll start handing out licenses. The first ones they go to are like ex-convicts, which is like hilarious because a lot of the list of ex-convicts. I think like someone posted it the other day. The first ex-convict to get a license in the state of New York was a guy who was like a stalker and like was tried for like child pornography or something like that. And everyone's like, what the hell is this? Like, how do these guys get licenses first, like social justice programs, blah, 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 when like we've been waiting for years and I haven't broken the law. It's like shit like that. And like that's kind of like what the mess is going on right now.
And there's another rabbit hole to go down there, which we won't. But a lot of the devil in the fine print, around social equity and who gets the licenses are so restrictive. Like you have to be have you have to be like a convict, but also have $1 million, and also have operating experience. There's like 10 people who are all illicit black market drug dealers. It's such a narrow profile. But I think maybe just to circle back to the Canada thing to round out the discussion, Canada is the worst place in the world to grow weed. I mean, it's cold as fuck. You're using greenhouse. You're paying high electricity. It's just not good product. There's a reason why 70% of the world's flower roses now is grown in Colombia, right? 12 hours a day, 12 hours, perfect sun, high altitude, no pesticides. So structurally, it's a lower margin locale. And then when you look at the capital structure for these companies like Tilray, Aurora, I mean, the retail shareholders are just pay pigs for management. There's massive dilution. There's no accountability of, capital and the return on the investment. The CEOs are handsomely rewarded, and everyone else gets written down to zero. And then they'll do reverse splits. They'll issue equity, and it's completely irresponsible. There's no other way to put it. But because of the liquidity, the factor exposure, if you're trading the sector and you can buy puts and calls, and there's a lot of ways that more savvy traders have used the LPs as a proxy for things that have happened in the US despite there being very little to zero fundamental impact.
Fascinating, guys. Clearly a lot to consider with cannabis that those of us who haven't done the work will need to do some more. I mean, the reality, like you said, though, it's going to happen federally at some point in time, and it will become an industry that's real and generates profit for someone. And what's the right valuation and all that sort of stuff, I guess, needs to get sussed out. Uh, Very interesting, guys. I appreciate you guys both sharing your insights and your familiarity with it. It's 5:50, so unless you guys had any other kind of last comments on cannabis that you wanted to get in, I'll wrap there. Let me pause.
No, and thank you for giving us the stage, Rod. When Playboy gets back to $13, we'll have a party at your place.
Uh, well, if it's Ben Cohen's resignation party, I think it'll get there. I don't think it can get there with him at the helm,
We might
but
even get the big bunny jet back at that price.
yes, yeah, we are as I've communicated, we are still assessing all options regarding our path forward as the one of the largest investors in the company, as Wook. Um, yeah, we not yet settled on a path, but we've got all options on the table, and the annual general meeting comes not too far away, so we'll see what happens. But you're right, Jimmy, like you were saying earlier, it is a challenge just given the horrendous governance structure that the company has. It certainly does seem like an insider enrichment scheme, and we'll do our best if that things go in that direction to ensure that the public is made aware of the truth. And I'll leave it at that. But with that said, I hope everyone enjoyed tuning in to our 11th Wook in Review. Just to recap, we will be hosting our book club, going over Howard Marks' memos on Tuesday at 7. We'll have that on Spaces, posting it on the Wook handle. Joe and I will continue on our personal handles. I'll be on my @Rod Alsman handle doing our Wednesday open mic discussions, which we had over 100 people this Wednesday. It was a really, really good time. I enjoyed it. So those have been good. It's been nice to get some different folks tuning in for those. And of course, we'll continue these Wook reviews on Fridays at the close, knowing that there will be a few as the holidays come around where we'll just have a newsletter out with folks on vacation and the like. But uh, yeah, so just to again, Wook Capital Management, we are a private investment fund. We believe that crowdsourcing research from retail investors really is a pathway to potentially realizing alpha. And we are looking forward to beginning some quarterly earnings call processes where we'll be hosting calls of kind of blue chip companies in as soon as fourth quarter 22 earnings roll around early next year. So we'll be hosting those that sort of programming. We'll be putting out more research on companies and a little in addition to these more general macroeconomic discussions that we've been having. So thanks folks for tuning in. If you want to learn more about us, wookcapital.com. wook.gg if you want to join our Discord server. And with that, this is Rod Alsman signing off. Have a great weekend, everyone.